You're in the Business Insurance Zone with me, Steve Savant, national financial columnist and money color commentator. This week on The Biz, our long-term care series, and on today's show, the long-term care policies versus LTC riders, with our special guest, nationally recognized long-term care expert, Stephen Foreman, all here on The Biz.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And today, controversy, and I mean controversy, with national columnist on long-term care, Steve Foreman. Welcome to the show, Steve.
Hi, good to be here.
Well, we'll see if it's good to be here, because we're going to be talking about the most controversial issue that's hit my desk in a long time, and that is, should we continue to put morbidity riders like long-term care, catastrophic care, terminal illness on mortality products? And are people just going to LTC-linked products because they have this idea in their head that long-term care standalone policies are so expensive, lose it, use it or lose it, all those mantras we've heard, right? Mm-hmm. Today we're going to talk about it, and you're listening to one of the most top of the table contrarian views. I don't mean to oversell it today, Steve, but let's just talk about it, because everybody asks me, and I don't even play in this league, and I get people saying, I saw my LinkedIn, somebody hit me for I'm a long-term care expert, and I wrote him back, I said, no, I'm not. Mm-hmm. I said, but I know who does, and that's Steve Foreman. Steve, let's open up with the defense, or maybe the propagation of what your side of this story.
Well, no, I don't want to get hate mail over this.
Oh, no, I say let it come.
I guess here's my feeling about the products in general. Mm-hmm. And I remember reading this Milliman study on linked benefits products when they came out so many years ago. And I guess my feeling, if I could sum it up, would be I feel like they were designed for consumers who don't want to buy long-term care to be sold by producers who don't know how to sell long-term care. Mm-hmm. So that's my summary.
Let's just say that, let's assume that your assumption is true.
Yes.
I do not believe most agents that I deal with, unless you're into disability, which is kind of a kissing cousin from a medical underwriting point of view, mm-hmm. Really, they really don't understand the definitions. They don't understand the legal language of these contracts. Mm-hmm. I think it's difficult to sell. Mm-hmm. And the bigger issue is somebody came out early on during the LTC rider phase when they were doing mm-hmm. R&D on this, came up with the mantra, if you don't use it, you won't lose it, and that's why this is a good deal. They put it on an annuity contract, and the thing that really pushed it over the edge was the Pension Protection Act. Yeah. Once they gave this deduction issue on the annuities, mm-hmm. oh my goodness, everybody started selling it. Mm-hmm. And 1035 mania, because now I could take mm-hmm. out, especially mm-hmm. under indemnification contracts, mm-hmm. I'm going to get a tax-free to pay my LTC for the rest of my life, or whenever the funds mm-hmm. run out or mm-hmm. the benefits run out. So that became the real issue. Now, here's my issue, Steve. Yeah. I'm just trying to be as fair as I can here.
Yeah.
I have mortality-driven carriers who are not in LTC, mm-hmm. not in DI, mm-hmm. not in medical, writing morbidity-linked products. Yeah. That's where I find that to be weird.
Yeah, I think you tend to understand the mechanics, the internal mm-hmm. rates of return, and that I think you understand the technical aspects of these products better than I do. I will hand that to you. I was at a conference recently where somebody who had also done similar analysis, but they kind of explained it to me in more plain-spoken language. You can tell me if this sounds correct, if this is a good summary. They explained that the inherent difficulty, or at least in pricing these products, was that you're trying to price for the same life where mortality is going one mm-hmm. way and morbidity is going the other direction, mm-hmm. and how can that work? Mm-hmm. Is that a summary of what you're trying to explain?
It's not only that, but let's just say let's do the life chassis first, because that's really the issue. We buy a life chassis, we know going in, pretty much everybody's priced their COIs on the 2001 CSO mortality table. Okay. I have been looking and flirting with the 2008 Society of Actuaries VBT tables because I think they're more accurate. Okay. And I do that for mostly planning the outline. Now I'm going to take a long-term care product. Now again, remember, my gripe is I have no actuaries that have morbidity training, so they're just putting this on because somebody said this is a good consumer issue. If I'm taking 30%, 40%, whatever percent of the death benefit, as a living benefit, right? I'm trading my cost of insurance over here, which I know what it is on the death benefit, but I may be actually pricing, I'm embedding a morbidity product at no cost to the consumer. So somebody's eating this cost. They say the crossover date, this is where you get back to your idea, they say the crossover date has shown them that that becomes the mark-to-mark profitability, that crossover point, and they think, oh, the client will be gone by then. See, to me, this is a major mistake. This is like, and this is a terrible comparison, but it's the only way I can make it work in my head. This is like comparing living benefits on a variable annuity contract, and why are these carriers coming back to the consumer now saying, can we buy them back from you? Because we can't commit to that kind of longevity and that kind of 6-7%. It's the same thing here. Can I commit to these kind of long-term benefits sitting on a mortality chassis, whether annuity or life, and I'm not paying for it? I'm embedding it in the product.
Yeah, you know, I was reviewing some of these products, you know, before coming in here, and you know, for one thing, the leverage did not appear to be that particularly good to me.
No.
So you know, and again, I'm not convinced that the market is as good as it's been suggested to me. I'm not exactly sure where the people are with this kind of money. It seems to me, again, when I look at it, the kind of leverage you can get from traditional long-term care. If long-term care is what you need, you could get particularly better leverage from a standalone long-term care product. If life insurance is what you need, I'm sure you could get better leverage from a standalone life insurance product.
It's been my thinking for 30 years that anytime you introduce two opposing planning issues, one of mortality and one of morbidity, one of the two suffers. You can never make a homogeneous product work perfectly, and one of those two items is really going to be negative for a consumer. After the break, we'll continue our expose on long-term care policies versus long-term care writers with national columnist Stephen Foreman. And don't forget, you can enroll at IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Hello everyone, I'm Steve Savant, host of the daily internet talk show, The Business Insurance Zone. I've been using Backup Technician for over 20 years for my edutainment workshops, public seminars, and my ultimate resource for my consumer shows. Why? Because it's the best needs analysis and sales support material that addresses almost every financial planning scenario. And now you can test drive Backup Technician absolutely free for the next 30 days. Go to thebiz.tv and click on the BizBlog menu and sign up for the most powerful resource available to financial advisors. Hello, welcome back to the Business Insurance Zone. I'm Steve Savant with Steve Foreman. And remember, you can order today's materials, and we have a ton, at thebiz.tv, thebiz.tv. And just a heads up, before moving forward with any of the things you hear on our show, always consult your tax advisor and broker-dealer compliance department before using all our great ideas on this show. We're talking about long-term care standalone policies or long-term care riders. And we're with long-term care expert Steve Foreman. Steve, one of the big mantras and why people have really went down this line of LTC rider products is because of the use it or lose it.
Right. You know, and that's kind of that's a myth that never really existed, because for the longest time you could purchase a long-term care policy with a return of a premium rider. You could purchase them with non-forfeiture benefits. Now they have contingent non-forfeiture benefits, and they've had return of premium riders. So the idea that there was a lack of ability to get your money back is kind of a myth. But another myth I wanted to explore is this. You know, I see this all the time. You know, companies and their press releases and advocates of linked benefit products are crowing about the enormous growth, which therefore leads people to believe there's enormous opportunity in linked benefit products. And trust me, I do believe that they will continue to be a niche. They will continue to serve a certain segment of the population. I think they should exist, and they will exist as a planning tool. Long-term care insurance alone cannot solve all problems. I also believe that there will need to be a government solution, a private solution, and linked benefits will continue to be part of that. But when I see things that say, well, you know, long-term care only grew 8% year over year, and linked benefits grew 50% over the previous year where they grew 50%. I think, well, that's easy to do when you sold 2 policies and then you sold 4 and then you sold 8. The overall market, when I looked at it and compared the number of long-term care policies sold compared to the number of linked benefit policies sold, long-term care, the industry is still about 50 times the size of the linked benefit industry. It dwarfs the number of policies sold. Now, I did have somebody from one of the carriers attempt to correct me and say, I think you got your numbers wrong. But he was including in his numbers accelerated benefit riders from what we would consider traditional life insurance policies. And I don't think, and you can correct me if you're wrong, that when we think of linked benefit or hybrid products, we're also including accelerated benefit riders.
Right.
I think
yeah, it would be unfair to throw that in to me because because we're basing that off of the death benefit reduction. So that's really not on the same table, and it would be unfair to make the comparison. When I'm thinking about this, we're looking at standalone contracts. I know that has an endearing quality, especially on annuities, and after the Pension Protection Act, this really gives a good light. And if this is all you have and that's all the client has, hey, I'm there for that. I'm okay. But to use this as a complete across the board substitute for long-term care, I think we're going to pay, and I think the carriers are going to pay.
That's true. I was thinking, if somebody has a long-term care planning need, then give them a long-term care planning solution. How many of your clients at that stage in life actually have a life insurance planning need? It may be an estate planning solution, but the reasons you're selling them a long-term, you're selling them a life insurance product to solve their long-term care planning need. And I brought this up with somebody, and he said, that may be true, but how many of their beneficiaries have ever been upset to receive a $100,000, $200,000 life insurance, check that they were not expecting? That seems like kind of a cop-out as a reason to sell the product.
Yeah, and again, remember, you don't have to drink my Kool-Aid, but I do not like mixing mortality and morbidity on the same chassis. To me, that's a major mistake, and it's playing both sides against the middle. The carriers say otherwise. They say it's profitable. But I just want you to know, when I'm retired 15, 20 years from now, and they're sitting there looking at the fiasco that they've created, just remember, I was on record of saying, I'm not sure this is really the way to go. Now, Steve, when we're talking about it, I think one of the things that really, if I have a death benefit need for estate planning or any of this, I'm doing it. I mean, I'm all over that. We live for that. But at the same time, we used to sell long-term care back in the day when it first came out, and we actually had traffic on this. We would sell long-term care, and the guy says, well, gee, Steve, what if I have to shell out all this premium? I said, you'll make it back on the death benefit we're going to do. We're just going to pay your death benefit. Anything you'd have spent on these premiums, any out-of-pocket with the long-term care facility, we're just going to give it back. People still speak about mortality reimbursement off death benefit at the changing of the guard or the transferring of the next generation. I don't know why we're homogenizing things that work against each other. There's no pure way to look at this. And again, we're talking about using a mortality and morbidity product. It's a little bit of my Kool-Aid. You don't have to drink it if you don't want to. But we're bringing up a counter-thinking way of approaching this. And we're saying LTC is not anywhere near as expensive as everybody makes it out to be. No. And especially if you get early on, like in these 50s and early 60s, it's really not that bad at all.
No, in fact, I know I've got a stat in here somewhere that says people generally tend to over appreciate how much long-term care costs. I think something like 60% of people that bought partnership policies spent less than $2,000, and something about 80% spent less than $2,500 a year. So it's far less than people appreciate. And again, tack on a return of premium rider, which is very inexpensive, and that's all coming back to the estate.
What I like is we're going to see some major changes here by the time April rolls around. And then by the time the fall hits, just before Long-Term Care Awareness Month comes out in November, we're going to have a pretty good idea. Hopefully you'll have Steve back on the show. We will give you the complete dossier of all the carriers, the policy provisions, everything you're going to need to sit in front of your client and map out not only their senior strategies for their retirement income, but do a little bit of defensive planning, which is getting our complete long-term care in order. And I think these policies, especially some of the big names you brought up, are a way to go. Remember, you can watch this entire week's series on long-term care by clicking our red on-demand video button right on our show's homepage at thebiz.tv. Well, that's the Buzz on the Biz for today. Get in the zone. The Business Insurance Zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.